Welcome, everybody. AFEX joined us very recently and wanted to come along and talk to us about currency volatility. This is a topic that I think interests a lot of our members. And I'd like to welcome Trevor Charsley, who's a senior advisor at AFEX. Trevor is an FCA-approved senior market advisor with over 25 years of trading and sales experience. He provides market analysis and views to the AFEX client base and helps clients structure and manage their FX hedging policies when required. Trevor provides a weekly blog
yes.
on the latest FX themes and is often quoted in the UK business press, including the Financial Times and Daily Telegraph. Most recently, over the Brexit vote, he was quoted in the Independent, the Wall Street Journal, the LA Times and CNBC.
Yes,
right.
yes.
Okay, over to you.
Thank you very much, Jane. Okay, good afternoon, ladies and gentlemen. Thank you so much for the invitation. Please feel free to ask questions. We have time. So normally I sort of speak or present for about 20-25 minutes. I think we've got longer than that, so maybe 30-35 minutes, or even a little bit more longer. So if you want to ask a question, please feel free, just put your hand up and we'll go through from there. Or you can please feel free to save them up to the end and we can have a chat. But certainly I like to be more interactive than anything else. Well, currency volatility is very interesting. You know, why bother? And quite often, sort of clients or prospects sort of say, well, you know, it goes up and down, and I just, you know, cover it spot sort of thing, and then I put it on my balance sheet or put it into my accounts, and off we go from there, and it's all fine. The rate is agreed. But in actual fact, certainly with Brexit and with big, you know, large events, when you have such volatility in the marketplace, and obviously sterling fell around about 20% across the board. Yes, it's excellent for people that are earning currencies, are earning revenues in other currencies, but in actual fact, it's like equity in your property. You only see the profit when you actually take the position back, when you put the money back into sterling. And obviously that means that you need to have a look at the market, you need to be up to date with the market, you need to really go, you know, have deep insight into the marketplace to try and time it correctly. And in actual fact, you know, sterling after Brexit, we were suggesting it would fall 20%. Yes, that was correct. But we've bounced back 15% against the dollar. And I wonder how many people just in the UK who have dollar exposure actually thought, you know what, I need to cover some at 20%. I need to cover some at 10%. And did they actually manage to book that profit, should we say? So it's an important thing to certainly consider. Now, the other point is working with MGAs for a number of years now. And there's often a time lag we're finding between fees that are billed or invoiced, certainly in other currencies and other continents, and actually when they arrive. Now that time lag sits in actual fact on the balance sheet. And this is a real issue because it means that you really don't know where your figures are, what your end numbers are. If the numbers come in, if the currency come in from another continent, it could be up to up to 2 years. And the amounts can run into millions. So if we're looking at, you know, a £5 million exposure and you move 20%, that's £1 million difference. Now, if you don't manage that, you're really at the mercy of the marketplace going up and down. But if you do manage it, you can actually, A, sleep properly, and B, you could actually add some potential to your business. So again, it's well worth having a look at that, and especially with balance sheet coverage. And we're finding actually that clients aren't quite aware that they're able to do this. And this is something that's very important. So that really is why bother. Now then, what we'll go through today, obviously the introduction, we'll look at volatility. Why has there been such a big bounce? And we do realise that it's very important for the insurance industry. Will the bounce continue? And then we'll look at how we can protect your business from currency volatility. We'll look at the forecasts and then obviously questions at the end. But please feel free to question, pop your hand up and question before then if you wish. Obviously Brexit's the main driver here. So what I wanted to show really was just the percentage moves over the last 12 months. So sterling dollar's been up, you know, 13.5%. So we're just above 140 today, and actually Jeremy Corbyn's been moving us this morning. So, which is an interesting one. Sterling euro, in actual fact, has been up and down 10.5%, and then so it was up, and then down again to have a range of 10.5%. Very, very volatile cross until last September, October. Sterling Australia, that's actually been up 10%. And I think many of the marketplace last year, this time last year, many analysts were suggesting, okay, Brexit's here, we're down 20%. You know what, the economy is going to struggle, all the doom mongers were there. And we were looking about going towards the 150s for sterling Oz. Well, actually, sterling Australian dollar is about 176, 177 as we speak, possibly poised to have a look at 180. That's a big difference to your balance sheet and to your market and to your P&L if you don't manage that. So just looking, just another slide, just really how FX moves affect the bottom line. Now, of course, these figures can go either way, to be honest with you. If you have a profit margin of 20% and you move 2% against you, obviously it's 10% on your bottom line, 5%, 25% against you, 10%, 50%, and obviously you lose the whole lot if it moves 20%. But what I would also say is you could get, you know, if the price moves your way, you could gain on that. But how many times, you know, if you're finance director, etc., and you say, oh, you know, I've just put in, you know, I've doubled our profits 100%, is the MD, is the CEO, is the board going to turn around and say, well, actually, we need to take this risk. This is huge risk. We need to take the risk out of the equation. Because if you are sort of saying, well, okay, the business, I could risk 100 or even 200% of the business, of the profits and the bottom line, then actually it makes sense to actually manage that currency risk because it's just so volatile. So why such a big bounce for sterling? Or many analysts suspected, you know, CPI would certainly go up 3% at the moment for our CPI. The UK standard of living, unfortunately, is popping down. Wages are only going up 2.5% per year, so we're actually losing. Our standard of living is going down. GDP, gosh, how many analysts, government analysts or whichever you prefer to read, you know, said that our gross domestic product was going to fall through the floor as soon as the Brexit vote happened. Well, actually, 1.7%, that's pretty good. I know we're behind the States and the Eurozone. The Eurozone is 2.6% growth and the States are 2.5%. But that's still not bad, certainly considering the, you know, the negative press and what we're going through at the moment. So that's been good news. The actual Brexit transition talks, yes, we got through the second stage, fantastic. And the market had to price that in. And as well, the Bank of England, actually, I would suggest they get a gold star for their last 12, 18 months of money management, shall we say, because they cut rates and help support and give confidence to the economy as soon as the Brexit vote was given. And in actual fact, putting rates up has really supported the pound. So they basically are, you know, they're one of the adults in the room. Now, they're now saying, and the weekend press was saying, actually, that there is now a 56% probability of a rate hike coming in May. So that will support sterling. So people were sort of thinking, you know, rates won't go up, the economy's going to stall, lots of Brexit bad news, etc., etc. But the economy is doing pretty well. And the Bank of England is saying, okay, you know, if things go well or continue to go as they are, we'll put rates up. So that will obviously help the pound. Now, the other thing is especially, obviously the mainly quoted, mainly traded cross is sterling dollar. But we've seen over the past 12 months the dollar come repeatedly lower. And that's despite rates going up 3 times in the States, despite Trump tax reforms, you know, and despite actually things going pretty well in the States on an economic level. Will this dollar weakness continue? We'll basically have to see what happens from there. But that's the reason why we've bounced so high. So, of course, where do we go from here? So will sterling continue to rise? Now, obviously, we're trying to agree the transition period at the moment. How long will that last? You know, if you read some of the press, they're sort of trying to suggest that we'll have a never-ending story as far as the transition period is concerned. But I would actually point to the fact that Theresa May has said around about 2 years, and the EU has said 20, 21 months. So we'll see. It'll probably be 2 years. I would be surprised if it was the never-ending story. As far as the conditions of the transition period is concerned, what I would suggest and what I would say is really, having read Article 50, which took all of 5 minutes, doesn't take very long at all, it basically means that it's like a divorce. And you say, darling, it's just time for me to go. And he or she says, don't want you to go, but you know what? That's fine. Legally, I write the divorce settlement. And actually, legally, that's where we are. We have no say. We can try and, negotiate with the EU, but they have we have no legal standing to say this is what we're going to accept. We actually have to accept either yes or no what the EU says. So I do expect, yet again, and the government has been sort of changing its tune recently on the transition period talks, that in actual fact we'll agree to what the EU says, and hopefully we'll get a transition period agreed before the end of March. Now, just to look at the big picture, really, we then have all of 6 months to agree the trade treaty framework, and literally it'll just be a framework. It's not going to be dotting the I's and crossing the T's. It will just be 6 months. It will be agreed hopefully by September. We'll know the bare bones, shall we say, but then the next 6 months will be taken up with national parliaments. Will have to vote this through their national parliaments, so the countries will have to vote through national parliaments, and then we'll go through the transition period, and Michel Barnier has said 2.5 years to actually agree a final trade treaty, and then we should be okay to leave in 2021, March 2021. Now, obviously, there's large debate around at the moment. Will the UK actually leave the single market and the customs union? It's interesting because Labour, I think, have stolen a march, shall we say, on the Conservatives on this, because the Conservatives have said, yes, we need to leave the single market and the customs union. The customs union is the important one. Well, they're both very important, but the customs union is important because we need to have left the customs union to make our own trade treaties. If we don't, then we're not allowed to. Now, Labour have said, of course, that they're, I think, announced today, Jeremy Corbyn said we need to be in the customs union. There are actually 10 Conservative MPs who have said they will vote against the government to stay in the customs union. Now, Labour's obviously is in opposition, and it's basically trying to split the Conservative government. If you do get a real split in the Conservative government and you get bad local elections in May, then I suggest that what will happen, we'll have a leadership contest. We may even have a vote of no confidence, and then you get into possibilities of a general election, and then you get into possibilities of a Labour government. Now, obviously, this is hypotheses, whatever, but there will be a large effect on the currency by politics over the next few months, at the very least. So I'd say, keep looking at the headlines, shall we say? So that could be one course. The other idea is, in actual fact, Theresa May and the government agree, stand together with the DUP and say, OK, fine, we're leaving the single market and the customs union, get it voted through, and we carry on going as far as the pound's concerned. What's happening at the moment with Brexit, on the effect on the UK economy? So our GDP did slip actually from 0.5% per quarter to 0.4% on the latest figures. So in actual fact, we are starting to slip. So that would mean that wouldn't be so sterling supportive. And I think as well, we need to consider, will the dollar continue to fall? Well, in actual fact, US interest rates at the moment, long-term US interest rates are starting to push higher. 10-year interest rates are around about to 3%. So if you're an investor, put your money into dollars, you get around about 3%, whereas in sterling, we're all of about 0.5%, 0.75. So there's a natural way for sterling, in actual fact, to start to come lower. So it's interesting. What I've put in here as well, the EU may well be affected by this, because obviously they have to decide who's going to pay, because the UK is a net contributor to the EU budget. Someone needs to pay for the shortfall of the UK leaving. So we'll have to see what happens there. That's obviously a big discussion point for them. And I think the other point is for the euro, certainly just for this week, we've got the Italian election this weekend, and we also have the SPD voting, the member vote on the Grand Coalition, between the SPD and the CDU. If that gets voted down, they're probably going to have another German election, which won't be good for the euro. So sterling euro could be very volatile this time next week, basically. So there's just such a lot to consider. So if you're thinking, well, OK, there's such a lot to consider, I just need to hedge my risk. So one way to hedge would be actually to look at a forward contract. So it allows you to fix the exchange rate on a set amount of currency for a certain amount of time. So that you go out for a year, up to 24 months, but certainly the amount of currency and length of time is chosen by you, and then you can literally hedge your currency out for 1 or 2 years. You can keep it rolling forward if you wish. If you do a 3-year hedge, you can then roll that hedge forward on an ongoing basis. So it means that in actual fact you can buy the foreign currency or sell the foreign currency at a prevailing market rate, pay for it at a later date. It can be up to 24 months depending on creditworthiness of the company. What it does do, it really provides certainty in volatile currency markets, and of course it can be tailored to your requirements. Now, obviously it takes, provides peace of mind, it provides transparency, so if you're in, if you're looking at hedging balance sheet risk, you know where you've hedged that balance sheet risk, you know the rate that you're covered, and it provides stability and protection against the risk of a constantly changing market. So obviously that's important to make sure that your profit margins aren't impacted. Now what I've done here is, this is the one of the most recent updates we have here. I'm a member of the Society of Technical Analysts, so I've taken my exams, so hopefully this, it means that this should make sense to me. We can see here that obviously the pound against the dollar has been generally going up, since April 2016, April 2016, apologies. We're around about the 140s at the moment. You could be seeing a top here, but in actual fact, if we don't break here 137.45, the probabilities would suggest that we're going to have another little look up here. And this is the sort of information that really that we can provide and help you guys to say, look, this is what we're suggesting, this is the latest sort of news and themes in the marketplace. And as you can see, if we don't go through, if we don't have this sizable downside retracement, and these support levels hold at 136.50 and 135, in actual fact, we might scoot up to 145. So if you're thinking, okay, I've got some dollars and I need to hedge them, where should I look? Well, you might decide at the moment, obviously it's ultimately your decision. Well, actually, if we look at 137, that might be an idea for the next 3 or 6 months. And then we look again, because you can roll the positions higher. And what it does is it manages your risk, it hedges your risk, and that's the most important thing. Now, as far as sterling euro, as we said, September 2016, gosh, it's been a very, very quiet marketplace. It's just been very rangy. So again, we would suggest that once you come around to the 111s, maybe 112s, it's quite happy to sort of cover risk here. But what I would say, very interesting at the moment, you've got some, certainly this week as well, you've got some issues, event risk around the euro, such as the SPD vote, such as the Italian elections. And in actual fact, Theresa May speaks on Friday, and if her speech is well received, and if we have to it's very interesting, the Labour Party says about a customs union, if the UK does stay in the customs union, ultimately that will mean less trauma for the UK economy, all politics aside, whatever. So in actual fact, the pound will be positive. It will be positive on that. So you could see, if you see this week people saying, oh well, actually the pound could stay in the customs union, you could see a little sniff above here, above the 115 and up to 116. But it is very, very rangy though. As you can see, if 114.50 breaks, then we suggest that 115, 116 could be seen here. So it's we're hoping for some more, some clarity, to be honest with you, from there. I've got to put in sterling Australian because, of course, I know that's an interesting cross for you gentlemen, ladies and gentlemen, as well as sterling rand, which is very interesting as well, with the recent developments. But sterling Aussie, I mean, we were down here at the 160s again in 2016, and you can see that 180 being a psychologically important level here. We may well see some resistance. We've had 2 attempts here. We've settled down. But in actual fact, if you get above 180, then we suggest that you can see 185. So again, have a look at the marketplace, understand the general themes, understand the technicals, and say, well, actually, in fact, I do need to cover. I do need to buy some sterling over the next, whatever, 2 months. So actually, it makes sense to cover some here, and maybe let's see if 180 holds on the top side. If it doesn't, if we get through 180, get to 181, maybe cover the rest. Or in actual fact, you could say, well, look, If we come lower, then we can see the 170s. So there's always this sort of idea you need to, it's almost like outsourcing your foreign exchange because there's so much going on in the marketplace and the themes always change. And in that case, what we're suggesting really is that hedge your risk, take away the uncertainty to a certain extent, and hopefully all will be well on the hedging side. Now this one here, apologies, these are the latest updates and forecasts from Bloomberg. And as you can see, really what we're suggesting, or what the market was suggesting, 145 for the highs for sterling dollar, 148 for Q3 2018, and the lows 121. So really, pay your money, take your pick. But actually, this is a bad Brexit, and that's a good Brexit. So it's well worth considering what your view is as well on how the Brexit negotiations go, and look out for the headlines. As far as sterling euro is concerned, 119 and 118 for the high, and 105, obviously a good Brexit and a bad Brexit. What I'd suggest here for sterling Australian dollar, you can see, market's getting quite bullish, or can be quite bullish for sterling Oz, but the median and the mean 175. So actually the market's pretty much got sterling Oz in its sights, shall we say. And it's interesting that the Reserve Bank of Australia is not going to join the rest of, well, it's not going to join the Bank of England, the Fed, and possibly the Euro, the ECB, which is possibly looking to tighten monetary conditions, and it said no chance of rate hikes. So in that case, sterling Oz could potentially have a little look at 180. So that's well worth sort of taking that into consideration. So thank you very much indeed for your time. What I'd suggest, any questions at all, on anything at all, more than happy to have a conversation, a debate, should we say, what we think about Brexit, what the latest ideas are, and obviously on the actual contracts themselves, if you'd like to have a conversation about if there was anything that wasn't very clear about how they can help and how they operate, please feel free to give me a shout.
Trevor, have we got any questions?
From Apex. Hi there. So Jeremy Corbyn spoke this morning, right? I'm not too sure how much he said. I watched it a bit, but how's that going to affect things, do you think, for the long term in terms of Brexit itself, the marketplace, perhaps what Theresa May might say on Friday as well? How do you see that panning out?
Okay, well obviously, thanks for the question, Tom. What I would suggest really is that Labour's becoming a more credible opposition than it has been over the past sort of 12 months, shall we say. Certainly Jeremy Corbyn, a more credible politician. If he can manoeuvre the government towards something like a soft Brexit, and I think it's well worth remembering Theresa May was a Remainer. And of course she really kept her cards very close to her chest. So actually a soft Brexit probably suits her as well. So if she can keep a government together, and we can go for a soft Brexit, you could see some serious gains for sterling. And this is a real. I think the market is sort of starting to wake up to this, because there was around about November, December, it was the Spanish and the Dutch finance ministers both said they'd like to give the UK a soft Brexit. They do lots of trade with the UK. UK friend quotes as being strong friends. Of course we are with the Europeans. And it's a case of, well, actually, if we do get a soft Brexit, you could see sterling dollar quickly scamper the 150s, maybe a little bit higher, and then we have to look again. And you've got the Bank of England putting rates up. And the market is ignoring the Federal Reserve putting their rates up. So you could really see some volatility if this sort of soft Brexit comes to the fore. And remember that Parliament has a majority for a soft Brexit. They want a soft Brexit. So it's how the Tory sort of Brexiteers are able to be managed. But I would suggest that we could see a lot higher sterling levels if that comes to pass. But of course, it's if that comes to pass. We've still got another 18 months, whatever. And certainly the transition period, hopefully it's agreed by the end of March. So it could be interesting times. Very volatile times, shall we say.
Interesting. Thank you.
Trevor, George, AFX. With Brexit at the moment, what are really the next key steps that are coming up in the calendar? What's really going to drive sterling euro, sterling dollar in coming months, with Brexit being at the core of those questions? what are the next key data points, basically?
Okay, as far as obviously data points, have a look for GDP, see how the UK economy is going, and also CPI. The Bank of England is very focused on inflation, and obviously the governor has to write a letter every time it's 3% and above. So he's not going to be too keen to do that. So we'll have to look at interest rates. On the other side, Carney was very clear. We needed to have a move to the stage 2 talks, which we've had by Christmas, and then we need to have a transition period agreed by the end of March. Now, it's the government that said they want the transition period agreed first, and then talk about trade talks. And it's interesting. I think it's well worth noting, keeping an eye certainly on Germany and Angela Merkel, because if anyone can fudge things, it's the EU, as we know with Greece, whatever. Merkel did say that for the UK to be given a bespoke trade deal doesn't mean that they're cherry picking. Well, in my book it does, but hey ho. If Angela Merkel says that it's not cherry picking, then in actual fact it could well get through. I think that the interesting point will be the French and how they look at how they interpret the EU laws, obviously with Michel Barnier as well. But if Germany goes for a soft Brexit and the UK has not put on the naughty step too much, then I think that, again, we could see some positive signs. The market will have to price that in. But I'd really look for end of March, and then we need to agree sort of the bare bones by September. If not, it could well be a messy Brexit. And I think you'll see the market, you could easily, if that's the case, you could easily see the market turn around and go south very quickly. If we, on the downside, if we break 137.45, that could be a precursor to more falls. And if we get through 130, then I think you might see 125, and then we'll have to take a look through there. But certainly look out for the headlines, and obviously, feel free to give us a call when you wish, sort of thing.
You think that the politics around the elections this week, and if you think that will have any impact and across people's wish to get a little bit further right across Europe?
Yes, this is the problem, I think, and it's very interesting that the German vote is to be announced on the same day as the Italian elections. And what I would say, I think we've become a little bit more accustomed to Italian political, I wouldn't call it upheaval, but certainly volatility. And it's very interesting, Five-Star Movement, everyone was saying they were very anti-Euro. They've actually reined back their rhetoric against the Euro. So even if they do get in, I would suggest it may not be too bad for the Euro. The other point is the Five-Star Movement has said that they're not going to go into coalition with any other party. Well, in that case, they're probably not going to get into government because they've only got 28% of the vote. So they're going to have to, whoever rules will have to rule by coalition. And that would suggest that we may get some sort of Berlusconi-backed coalition. In which case, I think the quote really is from Jean-Claude Juncker, who said, in actual fact, the biggest fear that he has is that Italy won't have a government come March the 5th. And I think that's the biggest thing. I don't think the market would take it too badly, to be honest with you. We're used to political volatility in Italy, so we'll have to see. It seems like the Italian banks are at least stable for a time. But we'll have to see how things go. It's going to be quite interesting there as well. I would suggest, though, Italy at the moment, I don't think it's going to be too much of I think maybe a storm in a teacup rather than anything else. But really, if Germany can't get a government together since the vote in last September, that will weigh on the euro. And I think that will help sterling euro push higher. So it's well worth looking for next Sunday, Monday, to see if that vote goes through. As far as looking at the polls, it would suggest that it would go through the Grand Coalition, and therefore sterling euro would do pretty much nothing. But if it doesn't, we need to be aware that sterling euro could push higher.
Any more questions? Okay, well, thank you very much, Trevor. Very informative. I think that Trevor and George and Tom will be around for a cup of coffee afterwards if anyone's got any specific questions they want to discuss. Thank you very much for coming along today, and we look forward to seeing you soon.